It's live at 5, a very special happy hour. It is November 2nd. Hi, everybody. Thanks for coming. My name is Dan Weiskopf. I'm the ETF professor and also lead ETF strategist for the ETF think tank and co-portfolio manager of Block. So today we've got 3 special guests, and thank you very much for coming. We're going to be talking about options. So with that, I'm going to hand it over to David. Thanks. Go ahead, David.
Thanks so much. David Jablonski here, fellow portfolio manager within the Tidal Financial Group. Very excited to talk all things options today. I'll kick it off to Cynthia Murphy.
Hey, everybody. Cynthia Murphy, head of research for the ETF think tank. Super excited. We have phenomenal expertise here joining us today. So let's get this going. Mike.
All right. I'm Mike Venuto. I'm the co-founder and CIO of Tidal Financial and everything behind the ETF think tank. We're really excited today because not only do we have 3 options, I'm not supposed to say experts, but let's just say, I'm going to say gurus, 3 options gurus who have unique strategies in the ETF format. And all 3 have funds with us on the Tidal platform. At Tidal, we help others launch and grow ETFs. And we're really excited about how this year we've seen the adoption of these unique strategies that, the term Delta 2 comes to mind, right? Or Delta 3, where you're not just getting the return of something that's beta, and you're getting the types of things that didn't used to be able to be put into an ETF. So we've got lots to go through today, and I'm really excited about it. So we're going to skip the drinking word. Now, that doesn't mean you can't have a drink with us. This is still a happy hour. We're still at the ETF think tank bar. But there's a lot to talk about, and I wanted to stay focused. If we talked about using options, and we don't want people falling down. So I'm going to kick it off to Sylvia first to let her introduce herself and her firm, and then we'll go to the other special options gurus. Sylvia?
Thank you, Mike. I'm Sylvia Jablonski. I'm the CEO and CIO of Defiance ETFs. We are both a thematic ETF issuer and now an enhanced options ETF issuer, which we've partnered with Tidal and Zagon. You'll learn a little bit more about that later. The 2 funds that are relevant to this discussion for us are QQQY, JEPI, and actually a third IWMY. There are 3 enhanced income funds. So very happy to be here. Excited to have the talk. And thanks for having me.
Wonderful. Let's go to Meb.
Hey, y'all. I don't know. I think I'd rather be an expert than a guru. I'm not sure. Do I get to choose? We're here in Los Angeles. It's a beautiful day. Day of the Dead. If anyone's seen Coco, I just watched that this week. That's kind of a tearjerker. Great movie, though. We have an ETF business, dozen funds, mostly quant type of stuff, systematic, a few more coming out by year end, and a couple new papers and strategies we're working on. I'm sure we'll talk a little more about them, and you can find our podcasts wherever good podcasts are sold.
All right, and Jay.
Hi, I'm Jay Pestrichelli, CEO and founder of Zega Financial. We're a registered investment advisor that specializes in options-based strategies. We are the sub-advisor on the yield-backed family of ETFs, as well as some others, and partnering with some other folks here, especially with Tidal. So happy to be here. Thanks for having us on today, Mike and team.
Wonderful. All right, so let's do a round robin on just why do you think this has happened, right? I mean, all 3 of you have seen growth in option strategies. These things are not exactly new, right? There's innovations in what all of you are doing, but the concepts of having option strategies out there have been around a long time, right? They've been buy-right ETFs forever. I was talking to Kevin Kelly the other day. He brought out one and sold it way, way early. It's now, ironically, I think the largest fund on Global X's platform. Why do you think investors are excited about this all of a sudden? Why don't we start with you, Jay, and then we'll go around.
Yeah, the beauty of options, the thing that I've seen being really embraced with options these days is the concept of, the getting more than the 5% you can get at risk free has still been hard to do. with traditional investing. And so I think investors have been searching for yield, and options are definitely a way of generating premium and, creating what I like to call alternative income or alternative yield. Typically people think of options as they could be speculative or even protective, and those have been around for a while. But I really, I've seen the real inflow come down the yield path. And this started really, I think, late 2021 when we saw those trends starting. And now, just seeing lots of adoption in both the retail space and in the institutional space, especially when you look at what 2022 did, and you saw that yield could certainly help deaden some movements in a down market when every asset class wasn't working. Option selling strategies could have worked pretty well in 2022. So, and some did. So I think that's really why I see the trend, Mike, kind of really picking up here, is that focus on yield. And I know I took the easy answer and just made it harder on every other panelist to answer that question right now. But to me, that's the obvious one.
All right. So then I think that flows to Sylvia. You have come out with yield, but also focusing on doing it with zero DTEs. Kind of explain the nexus of those two trends and maybe a little bit about what the heck a zero DTE is.
Yeah, sure. And I'll elaborate a little bit on Jay's point there. So I think, part of it and why I think we've seen the popularity of in our funds, which have grown a couple $100 million in less than 2 months. And, that's not something that you've actually seen in an ETF wrapper before. Some of these products that we have, and, YieldMax had, some of these other providers out there, are actually a lot higher than some of the typical buy rates you used to see. And then, interestingly enough, actually, we've talked to a lot of options experts and options traders that have run option strategies internally for private, high net worth clients, and their compliance due diligence areas just don't want them to do that anymore. They don't want them to actively trade options, and the fact that they're in a wrapper somehow make their groups, more comfortable with that product within their portfolio. But to answer your question, so zero DTE, or 1 day until expiry options, essentially are options that expire within a 24-hour period. So the way that our product works is, we go into buying at the money, slightly in the money puts at the close of, call it today, and then that trade is on round cash settled within a 24-hour period by the close tomorrow. And through doing that, our trader, who's on this call here, if you want to raise your hand, is able to capture, our expert here is able to capture, daily premium, essentially, through, selling these puts. And these options actually exist on NASDAQ and S&P 500. So, those are the two strategies we run. Russell is another one that kind of has options that list a couple of times a week. And yeah, the interest and just kind of appetite for these has been huge.
Wonderful. It's funny. Our show regular Warren Kaplan just mentioned he uses options to protect capital, which you both just talked about income. Meb, your strategy is quite different, right? What you do with tail and fail. You want to come in and chime in on what you're using option strategies for in your lineup?
Yeah, I think a big thing about options for a large percentage of investors, and I certainly put advisors into this bucket, is they're just a pain in the ass. And so, like, to be able to either execute or manage them on your own is one thing, but B, if you then have 10, 20, 100, 1,000 clients, being able to put on an option exposure for all of them, coordinate the trading to be able to give, and then key part of all this is then explain it to the clients, I think is really a challenge. And so one of the biggest adoptions we've seen is just the very simple understanding is that it's a one-click. It's like Amazon Prime. It's like you have one-click ability to put on a trade that you want the exposure to. And if you think about the OG of this in my mind, and it's not options, but it was derivatives thinking, was like DXJ, right? It's like when someone wanted to put on a yen hedged Nikkei trade, there was one choice for that where you didn't have to go muck around and make this like multi-leg trade. And so now you have the ability to, I think, place these exposures very easily and quickly and being able to explain it. And then even better, if it does poorly, you can blame the fund and not your own execution or strategy. and then the detractors, which, you certainly hear a lot of. I was in New York and someone was complaining about, I said, oh, we're going to launch a few new funds by year end. And they're like, oh my God, Meb. They said, did you know there's more ETFs than stocks? And my favorite response to this is always, I said, well, there's more words than letters. What's your point? And they just kind of pause and is very quiet. And they're like, I'm not sure what my point was, but my point is that there's a lot of ETFs. And I say, yeah, but that's a good thing, because now you can make these, get these exposures prepackaged in a way that's like going to the grocery store and being able to pick your type of cereal or beer. It's better than just having one choice of cornflakes and that's it.
Very glad. I've not heard that answer before. I think it's great. We track that open to close ratio, and it's back to 2-to-1. So for every 2 opening, 1's closing. A couple months ago, it was 1 closing for every 4.5. So I do think the industry's pretty healthy with that, and it's self-regulating. Weisskopf, I think you were up first with the hands. Fire away.
Yeah. So when I look at what's happened, there are a couple of things that I've seen. One, you've got some major firms coming in with option strategy that have effectively set things up so people have accepted what we all know has been acceptable for a long time. But there's also been inflation in the backdrop, right? And when I think about some of the strategies that are wrapped as option strategies, when you get your money faster through options, as an example, right? That kind of aligns with an inflation hedge. You think I'm right on this, or am I completely wrong that what's been happening in the way of inflation has nothing to do with all the money coming into options strategies? Who wants to?
I don't know who wants to jump on that one, but it's I see Sylvia. I do think it's interesting though, dude, because with options you need collateral, and up until a year and a half ago, collateral paid nothing. So I do think there's part of that, right? But go ahead, Sylvia. Why don't you jump on Dan's question?
Yeah, I mean, I think you kind of answered it, right? So
Sorry.
That's what it's no, I mean, that's one of the awesome things about, kind of how we think about the strategy, right? You start in this high income environment because you are getting that 5% on treasuries and that kind of allows a buffer for some of these products. So A, you get the 5%, and then B, you kind of get the extrinsic value of selling, the puts on a daily basis, and then, also whatever you get on the actual performance, intrinsic value, and you end up with these higher income environments. And then a lot of people ask us, sort of the reverse of that, like, well, what happens when rates crash down to 2%? Are these things going to now return, 3.5% and kind of go back to normal? These, 50, 60% income returns are gone. And, it's like, subtract 5 from 60, you're still pretty happy, right? So yeah, I mean, it's just I think it's the ability to earn some return on your collateral helps, your fund return in the end. So
Meb or Jay, anything to add on that one? It looks like we got a hand. Go ahead.
Yeah, I mean, I'll add, we were joking around before we went live about the correlation between bonds and stocks right now, right? So we're in this environment where those are tightly correlated. Finding something, we all know why that is, or at least we suspect why that is. So I think finding something that is not correlated, that can perform regardless, like an options income strategy where it could, be a separate, performance within a portfolio. So I would say, indirectly, the interest rate and inflation environment that we're in has caused options to be an alternative, or a nice alternative that didn't always exist before. Right? So I think that's an added piece.
Yeah, before we go to David with the new topic, Meb, you're one who doesn't use just traditional ultra short term for your collateral, right? You're using the 10-year more or less.
Yeah.
And we've used it in our ETF think tank models as kind of a bond replacement. Like, instead of a 10-year, we've got a 10-year plus a put on the market. How do you feel about the collateral that way now? Like, we've been living in that Tina trade forever.
Yeah.
Now we're in the Terra trade, right?
We wrote a paper called "What is the Safest Investing Asset?" that I think is a pretty non-consensus view, where we've been talking about collateral for a long time, in the sense that everyone had always assumed that T-bills were the safest asset. And That may be true on a nominal basis, but we all live in a real world. And so thinking about this, no one read this paper, by the way, because it was published when interest rates were 0. Well, now that they're 5, collateral has taken on an all new interest, since the days of Corzine, people thinking about collateral again. And it's funny because a decision that for many people may have been totally on the back burner for many years is now front of mind, because guess what? If your collateral was in T-bills over the last 2 years, you had a very different return path than if your collateral was in 30-year bonds. And I think people are starting to revisit a lot of the ideas in fixed income. We actually have a fixed income paper coming out hopefully by year end, so stay tuned on tactical ideas there. But this concept of what do you do with it is going to be something that I think everyone's going to revisit, in the sense that 5%, it feels like retirees have won the lottery. It's like they've been so ignore the fact their bonds are probably down 20%. But the fact you can now get 5%, it's like manna from heaven. I don't know. It's just like it's something that you haven't had in so long. It has reverberations almost everywhere outside of just T-bills and chill. I think it has much more impacts you've seen in money market funds, et cetera. And I could probably spend an hour talking about this, but the decision what to do with what used to just be the remainder is now front of mind.
All right, David, let's go in your direction. What do you got?
Yeah, I wanted to ask a question to Jay on trading a lot of these short-dated options. Like, is earnings season your Super Bowl, and what percentage of premiums are coming from this one period, right? These 4 trading days for a stock are obviously like these 4 couple-week periods for a broad index. Like, how much of the volatility in the income are you seeing from those periods versus everything else?
Yeah, I mean, 4 times a year we get this, increased interest. And as we're talking right now, I think I saw, a handful of tickers that had their earnings just come out, right? So I think it's those. It absolutely impacts the way that you want to take advantage of the elevated volatility in the option the option chain. Like, for example, it may sometimes even be not just 4 days. You may sometimes get 2 weeks, like typically in advance of NVIDIA, that stock, you could start to see volatility ticking up. And so what it allows you to do is give yourself, from a covered call perspective, it's always the art of balancing how far out of the money and how much premium you're going to bring in, right? And so when you have more vol, which typically, goes up 30, 40% going into earnings, it gives you a couple weeks of selling premium for a little more, but also giving yourself a chance to capture more of the upside. We saw that with Netflix a few weeks ago too, right? So it's just, right, a lot of the stocks that we work with on the Max brand are all, they have this implied volatility that gives you the chance to get a boost. And so with, monthly dividends, you get to see a change. You have month 1, month 2, and then month 3 is elevated because that underlying stock happened to have, an earnings announcement that came out. So it absolutely impacts it. It's something that should be considered. Any option traders watching that, and that's, again, it's one of those things that when you're deciding where you're going to sell calls and how far out you want to go, you absolutely have to be, aware of the earnings schedule. And then you want to try to take advantage of that as many times as you can by even covering early if something's down, or giving yourself extra room on the upside to kind of capture some, what I like to say, intrinsic appreciation as well as the time decay that you earned. So yeah, it absolutely matters. It's a big, big deal. It is one of the nice things about the single stock approach that we have in that ETF suite, that you get to do that 4 times a year per ticker.
Can I follow with a question? I don't know where my hand button is, so I'm just. But so it's a question. It kind of relates to the concept of trading and timing the trades. And I don't understand on the ODTE side of it. Like when we look at these option incomes products, and we've written some about it, the concept of, if you get really big, the fund gets really big, you can get a problem where the market can start timing your trades. We've seen it happen before, gaming your trades and kind of that hurting the performance of the fund. And the way these strategies tend to deal with it is either to stagger the trades, over a couple weeks, or because it tend to be monthly options. Like here, when you're talking DTEs, how do you manage the risk of becoming a victim of your own success? Or does that not apply on the 24-hour cycle? I don't understand the risks, how different they are on the ODTE space.
So do you want to take that one, or you want me to take a stab at it?
Yeah. I'll let you hit that one.
Okay. Yeah. I mean, those zero DTEs that you're talking about, Cynthia, are on, arguably the largest indexes in the world, right? I think Sylvia would be very pleased if her trades were actually moving the market because they were so large. I think, look, there's no more liquid market than the SPX, NDX, VIX, and RUT pits, right? Like those are obviously really, institutionally supported underlying tickers. And so I think it's going to be a long time before those ever get stressed. But the beauty of the Defiance funds is that it's a single trade, right? The Sylvia's funds have a single position. It's not a complicated position in there. It's one trade, and then you let it expire to cash. It's actually the simplicity of the, when you look at it, it might look very simple because it's a single trade that you put on and you let it, expire to cash each day. That helps a lot that you're not getting dinged on the entry and the exit within a wide options market. So I think the structure of that fund is, those funds are pretty clean. So, Sylvia, anything you want to add on top of that?
Yeah, no, I mean, I think, we keep seeing the SIBO data update, right? And it's, it's up to over $1 trillion now. So to your point, I think it would take a lot probably before somebody would sort of game us, or we would be in trouble on that.
All right, Dan, you're up.
Yeah, I know everybody's really focused on the equity side, and I understand why. But Meb kind of gave me a little teaser that I was kind of shocked when I was drilling deep on the kind of yield that you can get in fixed income covered calls, right? And Meb, I think you were mentioning that you're doing a white paper. Can you expand a little bit on what you're seeing in the way of fixed income? Because it's very twisted with the fixed income, because you may lose out in a huge way, but you're getting great income fast.
Yeah, income. So as we think about it, when you think about fixed income, it doesn't just mean one thing, right? I think there's all sorts of different type of bonds out there. You got your traditional U.S. government sovereigns. One of my favorite funds we launched and then repurposed, sadly, was a global sovereign high yield bond fund, which is totally different from U.S. sovereigns. Foreign government bonds, actually the largest asset in the world. Then you got corporates, you got tips, which people are quickly coming around to. I was dying laughing the other day because we love posting our polls on Twitter, and I asked a poll, I said, what real yield would you require to have in tips to sell your stocks? And the choices are 3%, 5%, 7%, or never. And like 80% of people said 5, 7, or never, which has never happened before, right? It's like historically stocks, the real premium, it's like 4% or 5%. So, I think there's an element of people have a hard time understanding the different flavors of bonds, not to mention junk and emerging and everything else. But you're starting to have a whole ton of interest again, because they've forgotten for many years in a different regime we have now, which is a whole generation of young people who are waking up to regarding, things like mortgages not being 3% anymore. But it's a world that was more normal than it was abnormal, which was the last few years. So the decisions on what you put your money into, I think, bonds have never been risk-free, but the zeros are darn near 50%, I think now, if not more. So
more
in our oldest book, we had a chart of the major asset classes. So stocks, foreign stocks, real estate, commodities, bonds. Very, very rarely do you get an asset class that goes down 3 years in a row. And here we are with bonds. So I'm not calling for a ripper in bonds next year, but it wouldn't be surprised to see it. So I think you're getting a whole generation of people that have never paid any attention to fixed income whatsoever starting to wake up and understand it's not just all about 10 years or T-bills, but there's a whole ocean of other types of bonds out there that are pretty interesting too.
Yeah, Jay, I'll come with the new questions after you chime in on this.
Yeah, I just have a question for Meb actually as a follow-up. Like, do you feel like as a PM, and I know from my side as an advisor, like there's this, everyone's waiting when it's time to add duration, right? Like, well, when is it? And which sector do you go to, or which side, right? Do you go high yield? Do you go investment grade? Do you go treasuries? Did you feel like everybody's just ready to add, right? But they haven't yet? Like, if you've successfully been able to hold back, you know, on your duration investment, like, don't you feel everyone, and when it goes, it's going to go like a cliff, right? I mean, do you think that's the way this is all going to go?
I'm going to add a link into the chat that is an interesting blog post we wrote. I think it's interesting. I wrote it, of course. And it was along the lines of stocks are allowed to be expensive because bond yields are low. Tina, right? That's what everyone said for years.
Sure.
And oddly enough, you don't have that many people that said that now saying, okay, well, actually, stocks are no allowed longer to be expensive because bond yields are 5. That's not what I'm going to talk about because I'll take up everybody's time. What I am going to mention is the thing we're thinking about a lot recently has been if you got T-bills at 5%, I'm going to make up these numbers, but you got T-bills at 5% just for simplicity. Does it make any sense to be buying hypothetically if junk bonds are also yielding 5? We would say, well, no, you're not getting paid appropriate amount of spread versus T-bills. Like you would want junk bonds to be at 10% or 12 or whatever. Ditto for emerging markets, ditto for 10-year, ditto for 30-year, ditto for tips. And so you can actually go back and model all these various markets. And I can't find that much in the academic literature. So panelists, listeners, if you find anything that really talks about this, I mean, it's a Howard Marks style in investing in fixed income, but basically trying to move into these various markets when the spread is justified. It's like a value approach to bonds. It's like buying stocks when they're in the cheap quartile. It's like buying bonds when the spread is wide enough to justify a term premium or, these other types of premiums. So it's an area I'm super interested in. The research I think is pretty promising and clear that that is the actual way to think about this as opposed to just kind of trying to do it on the fly. So if anyone else knows any research there, please send it over. I would love to see it. But that's something we've been spending a lot of time on. And ironically, right now, a lot of the spreads haven't blown out, relative to where they are historically for many of these markets, or at least I should say maybe not yet, TBD.
I was going to go in a different direction, but I know David has a fixed income question. So I'm going to just give you a little commentary on this, just some stats. We're filming this November 2nd, right? The Dow was up like 500 points today. Long-term treasuries represented by TLT or EDV or whatever was up like 3%, right? So like correlations are in a whole new world. You junk versus high quality, ag is down, high yield is up this year. So it is one of those like, cats and dogs living together, the Bill Murray kind of quote from Ghostbusters. David, we'll go to you and stay on fixed income, and then I'll jump back in because I see some other options questions in the chat.
Yeah, and I do believe the story of ag and high yield is a duration mismatch story between the two. But I mean, I agree. Like credit spreads are really tight. Duration has blown out. Duration seems really interesting. Credit doesn't. What I don't understand is how positively sloped can the yield curve really get? For the simple fact, we talked about this before the call. We all listen to advisors for decades talking about how they're going to meet these distribution rates for their clients. And now they're here, right? You get these 5 and 6% numbers at the long end of the curve. So it's just like a lot of people talked about how a lot of the money flows was an unwind of duration. And now I expect if there's a positive yield flow, a yield curve, for there to be that positive duration money flow. Like Meb, do you have expectations on the steepness of the yield curve? I want to ask you for actual rates, but let's just talk relative to the short end. It just, for me, that looks like a no-brainer buying opportunity. And to your point of drawdowns, in '08, equities had a 58% drawdown in the last 850 days. Euros had about 58 to 60% drawdown, so actually larger than equities did in 2008 over a much longer time period. But yeah, it's 2008 for Treasury bonds. I don't think people realize that. So
Yeah, the really telling thing is one of our old polls, and we said, what listeners or followers on Twitter, what's the biggest real drawdown after inflation for T-bills or 10-year, and everyone thought it was like 0 to 10%. So this was a couple of years ago, and so you assume that people are getting surprised by the bond drawdowns, which are getting to some pretty historic numbers, but at least on an after inflation basis, the 60s, 70s were really a time of a long erosion, whereas recently this is more of like a stock crashy type of drawdown. As far as the yield curve, yield curve is actually pretty predictive historically on a lot of assets. So a negative yield curve historically has been T-bills and gold. Kind of a flat yield. A normal yield curve has been stocks do just fine, and then a really steep yield curve tends to be like REITs and things that are longer duration, like 30-year. As far as what's going to cause that to shift, who knows, man? I that's your guess as good as mine. But you would think a return to a normal yield curve environment is probably we're probably due. One would think, but I don't. The timing on that is, I think, tough.
Go ahead, Jay. I'll let you go before.
Yeah, just an interesting comment. You got a panel full of options people, and we're talking about bonds, right? So just goes to show you where the volatility is right now in the market. That's it.
Yeah. And so I'm going to start pulling some of the questions from the audience here. So if you have a question, write it in either the Q&A or in the chat, and we'll get it up here. I'm going to start with Bob Cowan, and I think this one has to go to Sylvia. Really, I think our ETF professor, Dan Weisskopf, should read this because it's a structure question, but it's one of these ones that, with these new products, people it's not intuitive, right? And the ETF structure having this liquid option strategy in it, I get why they're asking the questions like this. So Bob is asking, does it not depend on that QQQY or your options writing fund on the NASDAQ having more green days than red days? Like, what would happen if there was 27 red days and only 3 green days? And I get it, right? You would think this has some sort of path dependency. Can you kind of explain what would happen in that scenario for your fund?
Yeah, I think that, there are different scenarios. One is sort of dependent on how much income or how much premium we're gathering on a daily basis in terms of what the difference in performance is, let's say, between QQQY and the NASDAQ. So a couple of recent examples, the other day we had NASDAQ down 1.7% and our fund was down 1.4% because there was that, 0.3 of premium that was captured. So it's sort of, it's not a hedge, but the income that was collected on that particular day buffered the fall of the fund. So, so not necessarily, right? If on a daily basis we're capturing, call it, 25 bips of extrinsic value, you get to about 70 or 62% of premium and income per year, and then kind of plus or minus what you're getting on the NASDAQ. So on the upside, you're kind of limited to what the strike price is, right? So you get a little bit of upside. And on the downside, the risk is the risk of the underlying index. So it sort of depends on, how those 27 red days go. What I would say is we would expect that we would be sort of less down. We're not going to grossly outperform if NASDAQ is down 30%, but maybe we will have, been down 25% because of the premium that we've gathered. And then if, NASDAQ is just rip-roaring up 20% in a day, we probably wouldn't experience that whole upside, but we would gather the entire premium for that day. So, kind of depends directionally on the market, but there's no sort of leverage. Each day we achieve this cash position and, that day's worth of performance on the NASDAQ. I don't know if you want to add anything there, Jay, but overall, should be down less, should be up, close to or in line with, plus premium earned.
No, I think you nailed it, right? It depends how those 27 down days come about. Even if it happens, it's still going to be, an outperformance against those, right? So, that is the beauty of that strategy for sure.
I think it's interesting because the question, the way it's asked, is about the down days. On the other side, though, on the up days, if it was 27 up days, we should, or I think, and correct me if I'm wrong, the fund should underperform, even though it's generating the huge premium.
Yeah, again, depends how those up days look.
Yeah.
Yeah.
And if they're 1%, then you get the whole upside, right? To the strike, you get the distance to the strike, right? So if you might get the whole upside if it's like 1 or 2%. I just ran this today, and since inception, like if you just run the total return of these types of funds versus the underlying index, we are indeed down quite less than the indices experienced in terms of performance over the last 6 weeks or so. So what you see there is that premium really helped you out in terms. I mean, it's hard to say helped you out when you're down. You're not happy usually, right? But it did help you out in terms of buffering some downside there. So now we're in the green, collecting premium. We'll see how it goes.
Great. David, did you have a question? Otherwise, I'm going to go back to the audience.
Yeah, I wanted to ask how, if you guys looked at, I assume you have the historical track record of reinvesting versus not reinvesting, and like any guidance that you guys have on that in terms of like how that might affect the longer term. And also, when would a strategy like this diverge from the monthly cousin of this strategy, right? So if you have a strategy like this with monthly cover calls, whether it's laddered or staggered or not, whatever the case may be, when are you going to see those biggest differences between, obviously the options premium is going to be much higher here, but when do they really divert from each other, and when are they more alike?
All right, I'll take the reinvestment question first, right? So you should absolutely be reinvesting dividends with these strategies. It's a conversation that we have all the time. Just because it's an ETF, it doesn't mean it shouldn't have management. It's an options-based strategy, right? So you want to make sure you're treating it as such. It's not a set it and forget it. You want to be able to compound your shares. This applies to Yield Max or to the Defiance funds, either one of them, because the idea of having these larger than usual typical yields that may come around, right, that they're just higher than the average dividend you're going to get off of a stock, it's one of those things that you have to compound those shares because you felt the drop in the NAV. Otherwise, you're just building up this, pile of cash from the dividends, and that cash isn't working for you any longer, right? I probably shouldn't say pile of cash, Mike, sorry. But you're just building up an allocation of cash that is growing probably faster than other allocations of cash are being added. So yeah, you want to put it back to work, right? I mean, again, you think about where these funds are being used in a portfolio. They are, I always call them alternative growth strategies, right? Where they are, the primary driver of returns is going to be the option premium you're generating. And so you want to put that back in, right? It's almost like, if you're just constantly taking money out of a stock that you held and just selling it as it was going up, that's fine, but that's not working for you anymore. So you want to compound the shares. The other thing about that is it then also will help increase the dollar difference you're giving, you're receiving in the distributions. So even if the fund price stays the same, right? If it just floats at, say, a theoretical $20, you're actually increasing the amount of distributions you're getting because you've increased your share count. I think if everybody can remember that your position value is what is important, not the underlying stock price or underlying ETF price that's important, right? It's shares times price equals position value. And what matters in your portfolio is your position value. It's a conversation that we have all the time with investors because they should absolutely be reinvesting those. So that to me is the way to use these. Sylvia, do you want to take the monthly versus daily on the option stuff, or do you want me to kick that one around for a minute? I think you're muted there, Sylvia.
Sorry, I'm trying to spare you all from my my horrible sounding hack here. But yeah, so on that one, I mean, in theory, it's sort of two things. One, we're selling the most expensive, sort of put on a daily basis. So 0 DTE puts have a data expiration. So you have sort of this high volatility. You're trying to capture 1 day's worth of premium, and it's more expensive, right, than monthly options. And then the second part of it is that, so why not capture selling the most expensive option, right? And then the second part of that would be that you have, more opportunities to capture yield. So with monthly, you're kind of locked in. It sort of is what it is. On, the ODTE, every single day, you're able to capture some value from selling, slightly in the money or at the money put. So that's the main difference. I mean, you could, in theory, outperform just because you have those extra days to kind of put some premium in your quiver.
I hope you feel better. I can tell you're struggling through, but we really appreciate you explaining it.
Yeah, for sure.
Dan, I want to go to
maybe a drink would help.
Yeah. Well, I said we're still having a happy hour. We just didn't want to go all in today. I'm going to go to Warren, Dan, and then we'll come to you. So Warren's, like I said, a long-term guest here. And earlier in the conversation, he was asking, do you have an objective when you're writing options, buying options? And I want to start with Meb with this, because I know we've talked a lot about income, but the objective that you're solving for is a little bit different. And, you recognize the problem in the marketplace with inverse funds, and you instead are approaching it using options differently. But let's go start with Meb, then we'll go to Jay for the yield max ones. I think we've pretty much hit it clear on the 0 DTEs that the objective is income. So go ahead, Meb.
Yeah, I mean, when we launched our tail risk strategies, I mean, the goal was really as allocators to outside funds. We often look around the landscape, and sometimes we find a category wanting. Like we say, hey, here's an exposure we want. It doesn't exist yet, or if it does, it's not quite packaged the way we'd like it to be, whether it's too expensive, too confusing. And so thinking about kind of tail risk strategies, we said, can we put together one that more aligns with what we want to put the trade on? And for us, that was thinking of a strategy, and we had spent an entire summer building a options database, which you've ever had to work with options is an order of magnitude harder than working with equities or futures even. And so futures probably closer, but we then found out we could kind of tease out the data from some CBOE indices at the end of the summer. So a summer wasted, but it felt like we earned it. The concept being is that we looked at, layering out options from like 3 to 15 months, and then how you pair that with collateral, which we talked about earlier. And the odd part on the collateral is you could come up with a few conclusions that I think in either scenario would have been acceptable. But for us, as we said, we want to design an inverse strategy that tries to lose less. That's kind of the goal of these insurance strategies. They're likely going to lose, but in the good times, in the bad times, provide some protection. And despite what the press would like to tell you, with some of these funds they claim that go up 5,000% in a month, et cetera, I will tell you, listeners, to do your own due diligence and to make sure you understand the math and how they're reporting it, because people, particularly journalists, like to take a little bit of liberty with some of the math or what they've been told. But that having been said, I think tail risk strategies, more than any other strategy we've offered, have a varied usage, which some people say I want these all the time insurance, like a life insurance, car insurance. Some people say, no, these are like a bond substitute because you get the bonds layered in already. And some people use them, which is the biggest sort of category is tactically speaking. They say to them, I think the market's going to crash. Where's Gaia when you need him? I think the market's too expensive. I think the market's in a downtrend, whatever. I'm going to layer this on. Or you can even short it, right? Which over time is probably the best way to go about it if you can sustain the ability to hold it. So I think designing it thoughtfully ahead of time and modeling it out is a useful experience, but they can get complicated quick, and it's not always doable for that long, or that, as you know, there's a couple tail risk strategies we would love to launch, but the market is just not liquid enough or deep enough to be able to do it, which is unfortunate. And the biggest whiff of my entire career to date, I'm sure there's gonna be bigger ones, is we had a long bond tail risk fund filed for a long time. And I said, what's the rush? Bond yields aren't going to go up anytime soon. And if they do, it'll be nice and, like we'll get a warning sign. And anyway, I think that fund would probably be up 1,000%. Just kidding. A zillion percent. Can I say that, compliance? Anyway.
Because it doesn't exist. So
yeah.
I believe you put the pinky. You got to do like the Dr. Evil pinky.
Yeah. So anyway, we
Piles of cash. And I'll be like to say.
All right. So before we go to Dan, Jay, you're behind not only the Yield Max suite, which for those who don't know, these are mostly single stock or single security where we're generating, or Jay is generating income. There's a lot of questions I can see in the chat about the fund to funds that's been filed for that will own multiple other Yield Max products. Unfortunately, we can't say much. I have to, the way this works is once we file, we just have to leave it there and can only basically read you the prospectus. If you want, we could read the whole prospectus on a show and that would be legal, but saying anything else is not. So we're happy to talk with you offline and discuss. But you've got Zega Buy and Hedge, you've got FIAX, you've got the whole Yield Max suite. Back to Warren's question, what other objectives are you looking at in these various different strategies when using options?
Yeah, I mean, it's you want to define the the return or cost that the options are going to have on your fund, right? So as like in Meb's scenario, right, you want to manage the drag that the option strategy is going to have on you in the good years, right? It's because you want to leave the value there for the bad years for that to excel, right? So that's obviously important. Flip side works when it comes to the income, right? You want to define that and then run the strategy against it because you have so many choices literally with options, right? I know it's a little bit of I'm not saying it jokingly. You literally have a lot of choices, right? How far out do you want to go in time? How much how far out of the money or in the money do you want to do these things? You want to figure out how much upside do you want to participate of the underlying, right? All of those things come into play. For the Yield Max funds, we've tried to simplify it down to the most basic message, which is it's all about harvesting volatility. That's why you do short-term options, right? It's why you're doing 1 week options. And sometimes we do it twice in a week, but it's why you are really, you have to have a target in mind. And for those funds, it's very simple. It's the implied volatility of that option, right? Of that option chain. So that's the baseline that you start with. So, why are we going for more yield on an Apple underlying versus a Tesla underlying, right? So those are the things that help you define and put those into frame it. And then people understand that the return of those funds should be commensurate with the risk of the underlying, because like any covered call strategy, which is how Yield Max works, you are still taking the risk of the underlying ticker, right? That's your main risk in all of this. Giving up some of the upside is a lost opportunity, of course, that is a risk, but it's not the actual your portfolio lost money risk, right? So it's stick with the volatility. Let the options market define what you're going for. And then, of course, when you're individually doing these types of things, and we do a lot of that for concentrated individuals, look, people have tax cost basis that they have to worry about. So you want to take those kinds of things into consideration, right? Sometimes people would be willing to sell Apple at, 180. Some people want to hold out to 220 because that gain pays for their, pays for the taxes that they have to pay on the growth, right? And then, so then you add time to all of that, right? Is that a 1 month, 3 month, 5 month, 1 year type of a trade? So it really, you have to define your objectives first and then build the option strategy around it. I've had calls where people say, hey, I want an option strategy. Okay, what are you trying to achieve? No, I want options. It's not the way it works, right? You tell us what you're trying to achieve. We'll build that model for you. And that's actually where the Yield Max idea came from, right? It was a really collaborative effort with Tidal, and we talked through this and we said, look, what is it that can make a difference in the marketplace and can kind of open some eyes, but yet still, be a covered call type set of returns. And so that was, that's really it. You define it up front. You know what you want to do. For those funds that we're talking about with the Yield Max family, it's use the volatility, the implied volatility of the options. Anybody who pulls an option chain can see that. That ends up being, the primary target. with those types of funds.
We accept shameless plugs at Tidal, but thank you.
Learn that one.
Yeah, yeah. We're gonna go to the professor. Go ahead, Dan.
Yeah, listen. This is a new asset class to some degree to many folks, and you guys have been fortunate in learning ahead of time, right, on how to build these portfolios and how they work. I've received a number of phone calls at times where somebody says, well, wait, I don't understand. This isn't going to be an 80% return every month on an annualized basis. My question is, for all three of you, where have you gotten educated on, what books have you read? What papers? And Meb, you've probably written 42 of them. But, where can people find out and learn how the math works?
Well, I'll go first, I guess, because I'm not muted, but I'll say that, look, it's yes, you can read about this, right? And you could read the theoretical. Practice, though, makes perfect, in my opinion, right? And so we know no advisor wants to learn on client money. We all know that, right? That's why folks like our products, all of these ETFs, are a great solution because nobody wants to learn on client money. But I jokingly say I pay tuition all the time. That's in other words to say an option trade kicked my butt, right? Like, it happens. And so you always have to you start with your worst case scenario. The only thing you can control when you invest is your risk. So if you understand that and define that ahead of time, then you take your positions from there. Look, I mean, the market is evolving quickly, Dan. Like, it's not the same market today than it was 2 years ago, 5 years ago, 10 years ago, right? When I wrote my book 12 years ago, right, there were things that didn't exist back then that exist today that are a better choice when it comes to investing, right? But look, it's to me, it's, fine. You could read a lot of the facts and the dynamics of options are the same, but doing it, there's nothing better than doing it, in my opinion. And that comes from a guy that started on the do-it-yourself side of the business, in the do-it-yourself broker world. But that's my thought, right? Pay your own tuition, but manage your risk when you do it.
Let's go to Meb and then Sylvia for the same question.
All this, you guys mentioned the topic of math, reading prospectuses already. This is like more work than I think 99% of investors are willing to do in an age of like, for the fund issuers, make sure you have the right title and the name. It's like reading the headline versus reading the article. It's like the headline of the fund, reading the fact sheet, and then maybe reading the prospectus. But thinking about the ideas behind these funds, I think certainly to the extent you can get, number one is always real-time performance, of course, right? And having a market cycle is always great for that. Second is like trying to have some sort of, simulated ideas about this. CBOE has a wealth of option-based indices that they, I think, still let you download in Excel format, and you can play around with those and build out all sorts of interesting ideas. There's obviously a ton of option literature out there that you can get books on, and stay away from Instagram probably, or TikTok. I think that's where all the frauds tend to hide for some reason on option-based strategies. Stick to the public ones, the ETFs. They're a lot more regulated. I'll kick it over to you guys. I don't know that if I have anything off the top of my head that's particularly a fantastic resource other than CBOE.
Well, it's already in the chat, but Weisskopf wrote about options this week. So let's go to Sylvia. Any suggestions from you on learning more? Like, I see a lot of questions that let me want to believe that some of these investors here have actually read the prospectus, because they're asking, why is it called risky? What they're asking about how these things decay. So there is a ton of desire for more knowledge here. Where can they find it?
Yeah, so actually I'm probably a good example, because the product, Tidal and Jay came to defiance with the product idea. So, our background and my background is levered inverse ETF trading, equity trading, kind of Delta One stuff. It certainly wasn't zero DTE. I hadn't even heard of zero DTE other than on, the channels that Meb brought up, like the TikTok people doing their thing. And actually, when I saw it there, it did spark a lot of interest, just because you kind of see these returns that people were talking about, and it's super interesting. So one, SIBO. So for me, I really have had to learn a lot of this from scratch. Number one is people like Jay and Meb that look at it all day long. Number two is SIBO. SIBO is actually a great resource. There's so much literature out there on this. And you kind of want to learn about all of it, right? Whether it's put right strategies, covered call strategies, the comparisons between the two. I learned, for example, we had so much pushback that put right strategy is just so risky and so dangerous, and you have to stick to covered call strategies. And when you learn more about it, you sort of see that the risk trade-offs are the same on these. So so places like SIBO, like clients asking us loads of questions has been an amazing resource, right? You kind of think about the things that are unclear to people, and you really kind of start to develop a narrative and a lot of knowledge about how this works. And then day to day I see how the product is being managed. I sort of see what the outcome is, and then you quickly kind of learn about the product. But SIBO is probably one of the best resources that I've seen for options. And there are a couple of, agree with Meb, there's a lot of junk out there, but there are a couple of YouTube channels, and we can get those links and send them around. Jay and I have talked to some of the hosts recently of a few kind of random shows, and there are some very knowledgeable options types of people out there too that really simplify things in a fun way to learn about it.
Okay. All right. So I'm going to stay with you, Sylvia. We're going to wrap up here. Just first off, congratulations, because I'm going to be with you, and a number of us are going to be together Monday morning. We're ringing the bell at the NASDAQ for QQY. So cheer us on, all you think tankers out there. I've put everybody's contact information in here. How do people stay connected with Defiance and all the things going on at Defiance ETFs?
You can go to our website, defianceetfs.com. We've got Twitter, we've got LinkedIn, but I'm kind of all over the place. You can find me on LinkedIn. You can find me on the Defiance website. Email me. We're super responsive, and our phones actually ring off the hook now since we launched these products. So happy to chat to anybody directly. But yeah, we're out there in the social media world.
All right. So same question for you, Jay. How do people learn more about YieldMax, Zega, FIAX, all the things that you're doing, all the launches? Tell us a little bit.
Yep. So yieldmaxetfs.com is the best place to get the info. Newly launched website, by the way. It's long overdue, so that's finally out there. So much slicker website. ZegaFinancial.com is also where you can find more about me and my firm as well.
And you, Meb, you and I are Twitter junkies, and we both try and get off of it, but we keep coming back. And your podcast is just amazingly well known in the industry. You want to tell people how they can contact Cambria Funds?
Yeah, I just deleted Twitter off my phone. I haven't deleted, as my wife said. You can still access it via the browser. And I said, well, yeah, but it's harder to get to. So it has like a little bit of a wall in between, little hurdle. CambriaFunds.com, CambriaInvestments.com. Podcast is Meb Faber Show. You can find contact info at any of those, or come see us in Manhattan Beach, California, and come knock on the door and say hi. We got a new office, and happy to give you a desk for a day if you want to come surfing or grab a coffee.
Wonderful. I mean, how many investment managers are so prolific writers and will invite you surfing? I've used the office before, so it is beautiful. Cynthia, next week we have Ethan Powell, right?
Yeah, we're talking impact investing next week with Ethan.
Yes, Cynthia and I are in a crusade to kill ESG and rebrand it as impact and actually change the world. And then after that, we're going to have our friends from Academy. They're a veteran-owned shop that recently launched with us a ETF that buys home loans for veterans. We'll be actually ringing the closing bell with them next Wednesday. So 2 bells, 2 exchanges next week for the Tidal think tank team. Super excited. This has been an awesome show. I know we didn't get to everybody's questions, but all of these folks up here are accessible and ready to talk with you. That there's a tweet that I put in there that's got everybody's handle. Feel free to reach out, DM us. We want to spread the education, and you got options. Have a great night, everyone.